Hi, Barbara Friedberg here from Barbara Friedberg Personal Finance, longtime portfolio manager, financial expert, here to talk to you about goal setting. Some of you might be thrilled to talk about goal setting, planning for retirement, and setting yourself up to buy a home, to pay for your child's education. Others of you may look at this task with disdain and think this is horrible, boring. But I have a tip to help motivate you. If you plan for financial goals, you will be more likely to reach them. The American Psychological Association, the ARP, many organizations have researched this topic and shown that those who take some time, set up a financial goal, a plan to reach their financial goals, reach them and are much more financially successful. So let's get started. Okay, why do you need to understand the difference between short, medium, and long-term financial goals? The basic reason is because the way you invest for those goals is very, very different. So let's define what those goals are, how you invest for them, and then we'll talk about a couple of ways to save for short-term financial goals, save and invest for medium, and save and invest for long-term financial goals. So let's get started. What are short, medium, and long-term financial goals? Short term is about a year or two. The type of goals that you'll have that come due within a year or two. Number one, you want an emergency account. So if you lose your job or you have a financial catastrophe, you've got 6-8 months of cash stored. So you won't have to go into your investment or retirement accounts. Okay. Then other short-term goals might be you want a new car, you want some cash available for home repairs, a remodel, or a really nice vacation, college tuition payments. Those type of goals go in your short-term bucket. Now are the medium-term goals, and these are tricky because there's tons of different definitions for what is a medium-term goal. Some people say 2 to 3 years, on up to 7 to 8 years. So there's kind of a little range there in how you want to invest for medium-term goals and what you want to invest in. Medium-term goals might include saving up a down payment for a new home, contributing to your daughter's college costs, maybe taking a work sabbatical or extended travel. You'll invest money for medium-term goals more conservatively than you will for long-term financial goals. Long-term financial goals pretty much are anything that's going to happen 8 to 10 years on out. That will include saving for retirement, which is most of our biggest long-term goal. And it might include paying for your child's college education in 10, 15, 20 years. Might include buying a second home or other big expenses that you can foresee in the future. Now, if you set yourself up today with a plan, it is much more likely that you're going to reach these goals. So how do you set your financial goals? Excuse me. Pardon me. Spam call. First, you want to write them down. And there's kind of a miracle in writing things down because when you write them down, you have already set an intention and you are already planning for these goals and starting to figure out what steps you need to take to reach them. Because life is all about balances. You could spend everything you earn today. And I can guarantee you that if you spend everything you earn every week or every month, then you're going to run into financial struggles. But if you set up a plan to divert part of your money into short-term goals, medium-term goals, and future long-term goals, you're smoothing out your income over your entire life, and you will reduce your financial worries. So here's how you start to create and set your short, medium, and long-term goals. Now, you can write this down. You can set it up on your computer, on Google Drive, in the cloud, wherever you want. But you'll start with each category and you'll make 3 columns. One is for the goal. Another is for the timeline. Timeline means how long is it going to take to reach that goal. For example, you want to buy a house and it's going to take you 3 to 4 years to save up a down payment. That's your timeline. And then a third column is for the cost. So how much do you think you'll need? 25,000, 50,000, 100,000. Here's an example of what your chart looks like. It doesn't have to be fancy, but it will get you on the path to figuring out what you want. You're going to find you're going to have more goals than you have money or are realistic. And that's where it comes to a point of, if you're writing them down, then you're making deliberate decisions and you won't fall prey to your whims of buying a timeshare you don't need, or walking into a dealership and walking off with a car that is too expensive. So here's an example what your chart's going to look like. It's pretty simple. Obviously, you can flesh it out to read as specific or as general as you would like. And then for each goal, you're going to include your date to attain the goal and the estimate of how much money to accomplish the goal. So for a 1 to 2 year goal, you want a new washing machine, you want to pay off debt, build a 3-month emergency fund. Although I like to build a greater emergency fund, 6 to 9 months, so you're not going to be stressed out and worried when you get a big bill and you have no cash to pay for it. The term of these short-term goals is 1 to 2 years. The amount is $10,000. Of course, you figure these amounts out yourself. Your medium-term goals, 2 to 8 years. Again, ballpark figure. Contribute to your daughter's college cost, down payment for a new home. 7 to 8 years, 2 to 8 years is the overall estimate. But these goals are going to come to fruition in 7 to 8 years, and you'll need $140,000. Long-term, 8+ years. Now, if you're 30 years old now, the term of this goal for retirement at age 65 is 35 years. And that's a good amount of time to amass $2,000. But starting earlier is going to mean that you're going to have to invest you will be able to invest a smaller amount of money than if you wait to tackle this goal until you're 35 or 40, because the longer you wait, the less time you have to compound your money. So next, we'll talk about where to invest in these goals. But before we do, you need a little bit of a primer on basic investing. Now, some of you may know this and you can fast forward through this part if you already do. But for those of you that don't understand different types of investments and how they link up with your goals, this will give you kind of a ballpark. And we use the historical returns of cash type investments, which will include your CDs, your short-term bonds, your money market accounts. And that will be measured by your 3-month treasury bill. Then we have government bonds, corporate bonds, and a whole array of bonds. Here, we're just using a proxy for bonds in general, and we're using the 10-year treasury bonds. Bonds are a loan, so you loan money to the government or a corporation. In exchange, they pay you a regular interest payment. Stocks are a percentage ownership in a company, and those have the potential to give you very nice returns, between 7 to 10% per year on average. And so those are your highest return investments. And you might think to yourself, Barbara, stocks, highest returns. I put all my money there and then I earn more money. Well, yeah, in theory, that's a super idea, except there is a problem with that thinking. And here's why you need to understand the differences between cash type, cash equivalent investments, bond investments, and stock investments. We'll go through a couple of quick charts and then flip back to our goal setting article. So just to give you a ballpark of the types of returns you get on stocks, bonds, and cash. Let's start with a 3-month treasury bill, which is a proxy for cash investments. And like I said, a cash investment might be a high yield cash account, and we'll put links below to where you can invest in high yield cash accounts. A certificate of deposit, a high yield money market account. Now today you're going to get around 5% per year, but those rates vary. 2 or 3 years ago, you were lucky to get 1%. The benefit of your cash investment is you will not lose principal. So if you invest $1,000 in a cash investment, you will get interest payments on that $1,000. So if you have a 5% interest rate, you will get $50 per year on a $1,000 investment. Now that's not great, okay? But this line represents your cash investment. Now, the principal's not going to change much. So if you invest $1,000 in a certificate of deposit, say a 6-month, 1 year, 2 year certificate of deposit, at the end of that term, when that investment comes due, you're going to get your money back. You will also receive an interest payment that was agreed upon in advance. Today, like I said, it's 5%, but there have been times where the interest rate has been practically nothing. And you can see on this chart from like 2009 to 2017, you had very, very, very low interest rates in cash. But that's okay because those investments, cash type investments, are used for your short term goals. You don't need a high investment. You need to make sure the cash will be there when you need it in the next year or two. So all the money you're going to need within the next 1, 2, 3 years should be in cash type investments, period. You'll notice this is the interest rate of cash investments, but your principal value will not vary. You will not lose principal. And that's really, really important. Now let's move on to your intermediate cash needs. And those will typically go predominantly in bonds because bonds will give you a little bit better return, but their prices are a little bit less volatile than stock investments. So, for example, today in a bond fund, an intermediate bond fund, you will get approximately 5%. Now, in the past, the rates were lower. The principal will rise and fall a little bit in interest rates, along with interest rates. So, when interest rates go up, the value of your bond fund will decline a bit. But when interest rates go down, the initial value of your bond fund will rise. Either way, you'll continue to get those bond premium interest rates. And the reason your intermediate cash should be, for shorter intermediate term goals, a mix of cash and shorter or medium term bonds, is because you'll get a little greater return, but you will also get, you will need to be prepared for a little bit more volatility in the value of those funds. And we use the 10-year bond as an example, but a shorter term bond would give you a little bit lower return, but a little less volatility. So again, typically, if you're looking at your intermediate, medium-term goals, the investments you'll want are cash investments and short to intermediate term bonds. Now, if you're going up to the 8-year period, if you have a goal that's 8, 10 years, you might throw in a little bit of stocks, but not much. And here is why. Look at this chart for the value of stocks. This is a sample of the value of the S&P 500. And that includes the 500 most important companies in the United States. These are the annual returns for the S&P 500 starting in 1973 on up to 2022. So you had a negative return here, negative, down actually 25% in 1974. But the next year was up 35%. Next year it was down a tad, a couple of points. Next year was up 30%. Next year it was down. Next couple of years it was up in the 20% range. So you get my drift. Returns are all over the place with the stock market. But the good news is if you invest in stocks, stock market funds over the long term, for example, from 1973 to 2022, you averaged 10% a year, which is amazing. That means $1,000 in 7 years is going to be worth $2,000. So your money will double every 7 years at a 10% return. Now, if you invested from 1973 to 2000, you earned an average annual almost 13% return. If you got in the market after the big crash of 2000, 2001, 2002, you see we had a big crash. If you got into the market then, well, your investment return in stocks was 6.2%. That's still pretty darn good on an average annual basis. But because returns are so volatile for the stock market, they are awesome for long-term goals that are 8+ years away. And those would be your retirement, your, future college payments 15 years away. So that's a lot to grasp. So now you know what short-term goals are, you know what to invest in for your short-term goals, and that would be cash equivalents, medium-term goals, depending how far away they are. You'll have a mix of intermediate-term bonds, maybe some short-term cash, and maybe a tad of stocks, but not a lot. Okay. So where do you invest? What type of accounts? These matter. For your long-term goals, you want your retirement accounts. You want those in a traditional or Roth IRA because these accounts are benefited by the government. Once you invest in them, you pay no taxes on the gains. You want some of your long-term goals to be contributed into your Roth, your 401k, your 403b, your TSA. So long-term monies go into these type of accounts. And in these accounts, you'll include stocks, you'll include long-term bonds, you won't include any cash investments. Now, your single or joint taxable investment brokerage accounts, those have no tax advantages, but they're good for any additional money that you're investing in. So you fill up the Roth, the IRA for your long-term goals, and then you open a single or joint taxable investment account, and you can invest in stock funds, bond funds, CDs, any sorts of investments in this type of account. There are no tax benefits, and you have, easy access to this cash. Short term, you want your money in cash equivalent investments. Wealthfront Save is an example of a company that offers a fee-free, high-yield cash account. And as a disclosure, if you do click on this link from the article, our company might receive a small commission. Okay, so you can short-term goals, high-yield cash account, money market mutual fund. I have some money in a Schwab Value Advantage money fund, a Fidelity government money market account. Or you can go to your bank and choose a high-yield savings account or a certificate of deposit. This is for your short-term cash needs. Now, what about long-term? You go to the stock market. That's where you want your long-term financial goals. I suggest investing in a diversified stock portfolio. Over the long term, you will find your money grows very nicely and compounds very well. If you want to do some retirement planning, find out how much your money will be worth over the long term, Empower has a free, sophisticated retirement planner. This is another one of my partners, so if you sign up for this and have over $100,000, our company might get a small commission. So let's wrap it up. Smart investors contrast their short, medium, and long-term goals and prepare distinct saving and investment strategies for each bucket. You'll invest conservatively in cash equivalent funds in easily accessible accounts like a cash or investment brokerage account or a bank savings account for all of your cash short-term needs. Then your money is available when you need it. Intermediate and long-term goals. Intermediate goals go in an investment account. Long-term goals can be split between, and goal money can be split between an investment account and your retirement accounts. And you should be investing in stock type investments for your long-term goals. You will benefit from higher long-term returns. Now, if you want to talk to a financial advisor, get some advice, I have partnered with someone else, which is Wiser Advisor, and they give you a fee-free access to 3 financial advisors in your area that you can talk with. You can even get a short free financial consultation. So for more information, you can access this article, the differences between short, long-term, and medium-term goals. You can access that through the link below. You can also access our historical stock and bond returns article with a link below. And I will also provide links to all the other resources we've talked about in this article. If you have questions or comments, I read them all. I like to respond. Please respond in the comments section below. I've also included a freebie for you, which is a brief micro book that I wrote that talks to you about how we grew our retirement account 965% over many years, of course. So thanks for stopping by. If you like this video, please subscribe, give us a thumbs up, and I will see you next time. Bye.